Wow, what a day we had in the US stock market. S&P 500 was down 1.85%, and while that doesn't sound overly dramatic, it was the financial sector that just blew everybody's minds because we had a stock in the S&P 500 today that was down 60% in a single day. The entire regional bank index was down 8% in a single day, which was its worst day since June of 2020 during the COVID crisis. Not only that, but the more broad-based financial sector ETF, which includes not just banks, but brokers, asset managers, insurance companies, and the like, that also suffered its worst day since June of 2020. Think about that for a second. Last year, 2022, was a terrible year for the stock market. Today, we had the worst day for the financials in an entire year plus. So that really puts things into perspective. As you can see, I'm wearing all black here today, so I figured I'd make a crack about Johnny Cash, but I'm not sure how much cash is left in some portfolios after today. So instead, you could just say I'm dressing for a funeral, the market's funeral. And there was a lot more fear and panic in the market here today. The VIX erupted higher. We do have a jobs number tomorrow, which could serve as a further catalyst of selling into the weekend. So things all of a sudden got a lot more chaotic here as a result of what we witnessed today. We'll take a look at all of that, see what it means for our posture. Then we'll get into our trade application example where I found a dividend aristocrat that does not have any long-term debt, that now has a monthly oversold cluster signal, and that has not happened since February of 2009 at the low of the last market. And we're going to take a look at selling a put on that in tonight's video. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 9th, 2023. First of all, if you're new, welcome aboard. Remember to go over to our YouTube channel, click subscribe there, and then go down into our description area. Make sure you're signed up for our email distribution list. So that way you can be notified whenever we post these videos. And remember, at the bottom of those emails, we'll also show you which stocks are giving you overbought and oversold cluster signals in the S&P 500. And I imagine there's going to be a lot of oversold cluster signals after today's heavy selling. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me. My handle is @BrandonVanZ, and we really appreciate those of you that click like and retweet on these Market Outlook posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And I hate to sound like a broken record, but this was almost an identical performance as what we were dealing with when I was last with you on Tuesday. And so, I don't want to start up all these bearish conditions every time I'm scheduled to do the video, but that's kind of how it's shaken out here lately. So anyway, as I mentioned here on Twitter just a moment ago, on Tuesday when I last did the video with you guys, there were only 30 stocks in the S&P 500 that were up, and I just checked here a moment ago, and today there were only 27. And so remember, that's only like 5 or 6% of the market closing in the green, and that happened twice in the last 3 days. So today felt to me a little bit more violent than what we experienced on Tuesday. I actually saw it in some of my statistics as well that I shared with many of you that follow me on Twitter. You might have seen my post here a moment ago after the bell rang that 31% of the stocks that I cover in the dividend stair-step charts, which there's approximately 700 of those companies, as of the end of February, 31% of those 700 companies were in what I would identify as the reasonably attractive zone based upon their historical yield standards. So 31%, remember that number. Fast forward to where we're at right now, which is only 9 days later. Remember, we're still in the early part of March here. So 9 days later, after having that formal post of 31%, today it was 38%. We're talking about a massive shift in a very small amount of time. And I did notice that even day over day, just from yesterday to today, there was a huge swath of stocks that fell back into their blue zone. Today, there were 15% more stocks that would have been considered undervalued or attractive based upon that theory than there was just yesterday. So that is a massive amount. Usually you see small differences, a couple more fall in, maybe a couple more fall out. But day over day, yesterday to today, we saw a huge amount. And that just kind of, speaks to the sheer panic that was taking place in some portions of the market here today. As we look at this heat map, you can see that one area should probably stand out to your eye, and that's the banks and the financials in general. Remember, we've had a few of those days here recently. It might have been last Thursday when I was with you, and again on Tuesday, because I feel like I've been mentioning this a couple of times here recently, but the banks have really fallen out of favor. And, there's a couple different reasons behind that. Some of you saw me tweeting about Silvergate Capital yesterday afternoon when they basically announced that they are going to shut down their bank, and that is the bank that's most closely aligned with cryptocurrencies. And that stock was already down 95% year over year before that announcement. And then they were down another 42% in after hours session last night, and kind of held true to that in today's normal session as well. And then that kind of bled over to some of the bigger companies. Now, Silvergate is a pretty small company. It's not going to upend the entire financial universe. It's interesting because of its direct connection to cryptocurrencies, but it's not enough to take down the whole capital structure or of capitalism as we know it, right? It's not J.P. Morgan, it's not Wells Fargo. But what we did see today was that there was a bigger bank called Silicon Valley Bank that absolutely got smashed. It was down 68% today. And it's not that that was a $100 billion company or anything like that either, but it was worth like $15 billion. And so basically with the snap of the fingers, you saw approximately $10 billion of market cap just completely wiped out. And as the name suggests, Silicon Valley Bank has a lot of clients in Silicon Valley. And naturally, there's going to be some very well-heeled clients there, as we've seen a lot of success out of that area of the world over the years. But that is also where you're going to find lots and lots of venture capital and angel investing and more speculative, disruptive types of companies that got loaned a lot of money over the years. And now all of a sudden, with interest rates rising, the question is whether they will be able to survive. And if they can't, then they might very well end up defaulting on a number of their loans. Some of those banks were raising capital after hours last night. So all of a sudden, this market feels different today than it did to me just even earlier this week. It's starting to feel a little bit more panicky. Remember that the financials are oftentimes stated to be the lifeblood of the stock market. Without the financials and the free-flowing capital and the access to capital, many other industries and sectors just seize up. We saw that take place, of course, in 2008 and 2009. There's a reason why Warren Buffett got all of the good deals, because he was one of the last men standing with the capital. Even the banks weren't loaning out money because they were so afraid that the moment they loaned out of money to some other business, that it would end up, going bankrupt and defaulting. And so, it really is something that for 95% of the time you're involved in the stock market doesn't mean much of anything. But in the 5% of the time when it means something, it means everything, because everything starts to freeze up, and there's all kinds of systemic domino effects that take place after that. So today was particularly concerning in my eyes, and suggests that we have tougher times in front of us for everybody who thought that we were going to go through some sort of a soft landing. Remember, there's a lot of people out there, and who knows, maybe we still do. It's always hard to determine. Nobody has a crystal ball, but it's looking less and less likely here all of a sudden after today's activity. Yes, we still have a strong labor market, and by the way, we'll find out more about that tomorrow morning. And I sure hope that the number is not particularly concerning. And remember where we're at right now, because the market is so concerned about rising interest rates. The more concerning number would be if the unemployment number is spectacular, because that would suggest that Jerome Powell isn't anywhere near done with his interest rate rising campaign. And so in a strange way, we hope that tomorrow we learn of a lot of people that got laid off here in the previous month, and I'm not so sure that's going to happen. If following up on today's selling, that could get really ugly because tomorrow could be a catalyst, right? As we head into the weekend. Remember that when we get into those really hairy markets, oftentimes markets have terrible Fridays because nobody wants to hold their stocks through the weekend as they know that further bad news could emerge. So, we have the makings of what could be a pretty ugly day tomorrow. I hope that's not the case, but, we just have to be realistic with the situation. So today, those financials absolutely got drilled. Schwab actually worked out nicely for one of my classes. We were shorting Schwab, and as you can see, it was down 12% today. We were able to shut down that trade at max gain. So for those of you that are premium members of Market Scholars, you would have seen my Telegram note on that earlier today. So at least from that perspective, we were happy. But for the most part, if you were long the financials to any degree, today did not make you very happy at all. It looks like maybe just one Moody's Bank, or not Moody's Bank, but Moody's, the credit rating agency, was up by 0.32%. MSCI didn't quite get into the green. It might have been just one. Let me right click and zoom in on only the financials. And I think that was the case. That is amazing, right? Sometimes I show you guys these statistics when we're looking at the heat map and we look at something like the energy sector or the utilities sector or the REITs. And I say, hey, today was a clean sweep, or we only had one, in the green, or, other days maybe we only have one in the red, or what have you. But rarely do I have that conversation with you guys here about the financials. The financial sector is quite wide ranging. Obviously, you have your banks, you have your brokers like Schwab, you have your insurance companies, you have a wide variety of insurance companies, by the way, life insurance and property casualty, what have you, and other capital markets types of companies. You also have the asset managers. So it's a little bit more of a far-flung type of a sector. It is quite rare to have this dramatic and overwhelming day on either the upside or the downside, where only one out of all of these, this is one of the bigger sectors out there from a components perspective, only one closed in the green today, and we had some that just got blitzed here, including Schwab. Now, Silicon Valley Bank must not be in the S&P 500 because I don't see any really bright red one there, and it was down 68% today. So I don't see that one. It must be too small to be in the S&P 500. So that was fortunate for that. Actually, you know what? I take that back. I do see it now with my eyes down here. What's strange about it is I was expecting it to stand out a lot more. But you can see kind of the scale that this uses on Thinkorswim, where basically the brightest colors are in the 8% plus territory. For green, it would be the brightest green, but when you're down 8% or more, it would be the brightest red. And I guess it just doesn't stand out to my eye because pretty much everything that surrounds it was also down 8%. But this is not some sort of a glitch that you're looking at here when I'm pointing at ticker symbol SIVB. It literally was down 60% in the normal market session and is even down further in the after hours right now. You do not see that very often in the S&P 500. In a single day, more than half of the market cap of a company completely vanish. We had a few days like that back in 0809, right, when we were dealing with Lehman Brothers and Bear Stearns and that type of a thing. But in normal operating market conditions, it is incredibly rare to see a stock in the S&P 500 down 60% in a single day, especially since I don't think they even reported their earnings, right? You would think that it would be something more dramatic than that. But this is kind of like the equivalent of a run on the bank right now that we're looking at right here. So that was just unreal to see there. They don't pay a dividend, which I'm thankful for, because sometimes you wonder, are you going to run into one of these buzzsaws in your long-term portfolio? But fortunately, that's not one that we've ever had in my dividend accounts. However, there's been plenty of others that we have owned, like US Bank and JP Morgan and Wells Fargo and a number of those that, of course, did get hit today. So that's the shrapnel effect that takes place there. But without a doubt, in my eyes, the sector of the day is what you're staring at right now. The financials got absolutely bludgeoned. In fact, I think that I saw, and I retweeted this earlier, it might have been from Mike Zakari, But anyway, he was saying that KBE suffered its worst day since 2020, basically during the COVID wipeout period. And so let me actually go back here and show you real quick, because I never did confirm it with my own eyes, but I trust that Mike knows what he's talking about. So let's just pull it up. I think it was KRE. And this is the regional banking ETF, KRE. It's a fairly liquid and well-regarded ETF. It was down 8% today. This is an entire ETF that has probably dozens, if not hundreds of companies in it. And the average company within this ETF that is, expected to have enough diversification to, suffer any dramatic blows, it was down 8% in a single day. So that is dramatic with a capital D. I would be curious when we pull it up here on chart 6D here, you can see exactly how ugly that is for KRE right here. Again, regional banks got demolished here today, down 8%. Here's what that red bar looks like. It doesn't come close to anything else on the board. The second worst day for it was back here on December 5th of last year, and it was down 5% that day. Today it was down over 8%. And to prove Mike's point, I'm going to go back over let's do a 3-year daily time period, so that way we can compare apples to apples here. And you can see, indeed, the last time we were down this much on this ETF was this day back here during COVID, and it was on June 11th of 2020, and it was down 9% that day. Now, of course, in March, when things were really chaotic, we had days where the whole S&P 500 was down like 9%, right? So it's not as surprising to see it down aggressively during those days that you see exactly 3 years ago. That is kind of interesting as well. We're now passing the 3-year anniversary of the craziest time period during COVID of March of 2020. Remember, that was at a time when they had to cancel the rest of the NBA season. I remember, I live out here in Utah, so Rudy Gobert was still playing for the Jazz at the time, and he was really one of the reasons that kicked off the entire, NBA season getting shut down at that exact moment in time, which then led to the entire cancellation of the March Madness basketball tournament, which I had never seen or even thought about in my lifetime. So that was a wild, wild time we were all going through exactly 3 years ago, and we're still here standing, right? We survived that, and whatever we're going through right now, we'll survive this as well. It's important to keep a cool head on our shoulders despite the difficult sessions that we have. But this really kind of, puts an emphasis or an exclamation point on today's trading, where this regional bank ETF was literally down 8% in a single day. So that is the epitome of damage out there. And as we go back over to the S&P 500 to kind of wrap up that conversation on the heat map, there wasn't much in the way of green out there anywhere. Certainly no real patterns emerging. GE was notable for hitting a multi-year high here today. It was actually up 5%. Of course, that company is basically a shell of its former self, so I don't know, how much, of a parade we should throw for it there. They've done a lot of spin-offs and things like that over the years as well, so it's a little bit more difficult to compare on an apples-to-apples basis. Nonetheless, a rare bright spot there for those of you that might be GE shareholders. Today, Intel was up. Of course, they've been destroyed over the last year like so many other companies. But remember when I was with you on Tuesday, I was mentioning how the Dow only had one single company that was up, and that was Merck on Tuesday. Well, today it was the same thing. Only one single company in the Dow was up, and in this case it happened to be Intel. So both Tuesday and Thursday, the Dow had 29 out of 30 stocks in the red. You don't see that very often either. Back to the S&P 500 now. What else was up out there? Eli Lilly was up today. We actually talked about Eli Lilly quite a bit in my question and answer session earlier today when comparing it to another company. Chipotle was up today. So for those of you that are, feasting on your burritos, and some of you saw my tweet here a week ago or so, they have the fajita quesadillas now. So I've always liked their peppers there that I like to throw in the burritos, but now they're adding the peppers and onions into the quesadillas as well. So maybe a little bit of a boost there from Chipotle. I also saw that one of the home builders was up today, D.R. Horton. It's one that we've looked at in my top-down trend trading class. Phillips 66 was up today, kind of much to my chagrin. What I mean by that, for those of you that have been attending my dividend growth investing class here in this semester, you'll know that I've been waiting with as much patience as I can get for Phillips 66 to fall back into the blue zone, and it just has refused to do that. So today didn't really help in that regard. It went up when the rest of the sector was down. We see that the trash collectors were up today. Waste Management and Republic Services both managed to close in the green. That's an area of our economy that will continue to push forward regardless of what our economic future holds. We saw Vertex Pharmaceuticals was up today. A few other healthcare related names were in the green, but again, no real patterns were emerging. This was a bloody day, one that was emphasized mostly by the financials. That is by far and away, in my eyes, the big story of the day. But Tesla was down 5% as an example. Amazon was down about 2%. Apple and Microsoft both down. Alphabet down over 2%. So a lot of your big boys didn't really hold up their end of the bargain. Even Nvidia down 3% here today. And so that didn't help the story, but I think the script was set when we saw those banks get demolished right out of the gate here this morning. This was something that we knew going into the session today. Remember, I do what's known as the 9 at 9 each morning. And that will show you which stocks are up the most and which stocks are down the most at 9 a.m. Eastern time. So that's a half an hour before the market opens. So that way we can kind of get a lay of the land before the opening bell to understand what to expect out of the market. And even before the bell, we had a bunch of those banks and financial companies down significantly in the pre-market. I think Silicon Valley Bank was down like 30% in the pre-market session, and who knew at that time that was actually not even a smidgen of what was to come. Eventually, that stock would close down 60% by the time the closing bell rang. So we had a feeling that today would be one of these pretty ugly days, especially led lower by the banks and other financial companies. I already mentioned this, but just so you can confirm it with your own eyes, the breadth numbers. You can see that 27 stocks in the S&P 500 closed higher today, which means that basically 95% of the market closed in the red here today. It was an overwhelming day for the bears. And one of the things that I had mentioned to you guys on Tuesday that I found to be somewhat peculiar is, let me go back over here to just a 1 year, 1 day chart and take a look here at the VIX. Remember on Tuesday I was saying, boy, that was sure goofy. We had a pretty ugly sell-off in the market. It was like down 1.6% or whatever it was. So somewhat comparable to what we had today. The market was down about 1.8% today. But to me, today felt a lot different than Tuesday. Today, it felt like the market was really taking risks more seriously today, because it felt like stuff was breaking behind the scenes in the financial world. And that has now been identified by the VIX as well. Remember on Tuesday, this was the candle of the VIX, the one that I'm pointing at right here. Notice that it barely even moved. I'm like, I was saying sarcastically that the VIX went all the way up to almost 20. And of course, I was just joking about that because I was explaining to you guys at that time that 20 was still considered very low. And most of the time over the last year, the VIX has been well above 20. So it was very strange that the VIX couldn't even get above 20 on a fairly big sell-off day. Remember, on Tuesday, that was the third worst day of the year. Fast forward to where we're at right now, that's no longer the case, because this day today turned into the second worst day of the year. But notice the difference between the VIX candle on Tuesday versus the VIX candle today. Now we're getting somewhere. this is a pretty major move in the VIX, right? It was up 18% today. Again, I know, don't look at a percentage with a percentage, but just to give you an idea, right? It was like 6% move or whatever it was on Tuesday by comparison. So this was much more in line with what my mind would expect when the market is truly concerned. Tuesday, it didn't really feel that way to me. It didn't feel panicky. It didn't feel like there was some sort of a domino effect taking place behind the scenes. Today felt completely different to me. Today felt like, yes, there is worry in the marketplace. Batten down the hatches. The market is about to get really chaotic. Obviously things can change, so we got to keep our eye on it day by day. But today was kind of like a wake-up call, it seemed to me. It seemed like the market has been in la-la land for much of 2023, thinking that, we're going to have this soft landing and we're going to go right back to the good old times and head back to all-time highs again. And the truth is, we just didn't really see a pathway of lowering interest rates. We still have too hot of an economy, which basically ensures that Jerome Powell is going to keep pressing on the neck of the market with higher and higher interest rates until his job is finished. And today the market woke up in a big way. VIX soared. We're still at a reasonably low level of 22. Remember, we got to 36 on the VIX back here in May of last year. And even in the follow-up sell-off in the market, the VIX got up here to about 35 in the fall of last year. We're nowhere near either of those two levels right now. So while this could be a catalyst and set off, a big move in the market lower and higher in volatility, this is not the end of the move. That's kind of the scary part, right? This could be the start of something, not the end of something. Now, again, tomorrow's the jobs number and things can change there, but it could also be just a continuation of today's, catalyst. So I feel like this is more of a precarious moment in time that we're all dealing with right here, right now. So, buckle up. It's very, very dicey out there right now, and the VIX is finally waking up to that fact. Anyway, let's take a look at the S&P 500 from this perspective. Confirm what I just told you a moment ago, which is today is now the second worst day of 2023. This day back here on February 21st was still worse when it was all said and done, at least based upon the closing prices. On that day, we closed basically lower exactly at 2%. Today, we were lower by 1.85%. So not quite the worst day of the year, but within a stone's throw of it. And to have that happen, after Tuesday's information, that's a pretty ugly 2 out of 3 day setup that we have there, where the bears are really starting to take control of this market a little bit more aggressively. Let's take a look at our normal 4 grid now. This is chart 4B for those of you following along at home. And in one of my question and answer session, responses here earlier today, I did explain how this 4 grid works. So for those of you that are premium members, you're welcome to go listen to my recording from class earlier today if that's a topic of interest to you. But one thing that I just had to chuckle about when I pulled this up right before recording is that it seems like when I've been doing the video here lately, we've been a little bit more bearish. I don't know if I necessarily want my name associated with bearishness. Nonetheless, it is what it is. The reason I say that is because most of you know I do the video on Tuesdays and Thursdays. David does the video on Monday, Wednesday, Friday. And it's just strange how it's shaken out here lately. If we bring up the S&P 500, Thursday of last week would have been the 2nd. So when we look at where we were on the 2nd, it was this day. And notice that we had that dark pink background color. We were bearish that day. Wouldn't you know, the very next day on Friday, when David did the video, we went back to the bullish posture. And then he did the video again on Monday, and we were still in the bullish posture. And then when it's time for Brandon to do the video again on Tuesday, we went back to that bearish posture. Wouldn't you know, yesterday when David did the video, we went back to the weekly bullish posture. And then here we go again when Brandon's scheduled to do the video, back to the bearishness. So very, very strange to see it shake out based upon David and I's recording schedule. And obviously that is complete coincidence, has nothing to do with anything going on in the markets, but I just found it to be fascinating nonetheless, because it's given me an opportunity here to do more of these sold put trades that I like to share with you guys when we have aggressive sell-off days. And I'm sure none of you are surprised when you will find out that I've done another sold put trade for tonight's video that we'll learn about a little bit later. Of course, those of you that are premium members already know what the trade is, because I sent it out via Telegram during the normal market session. But it's just very interesting to me, because some of you heard me complaining every so often during this big move in January that I hadn't really gotten a chance to share any of those sold put trades with you, because the market just kept on marching higher and higher. In the rare days where it was, selling off, I was not the one doing the video that day. So I was kind of chomping at the bit to do a few more of these sold puts. And it looks like the market is finally accommodating me, because it seems like when I've been doing the videos here more recently, we've had exactly those opportunities. So we are back, just to put a ribbon on it, we are back to a strongly bearish posture again. Another thing to be aware of is normally we don't have this type of back and forth posture changes, right? Usually once a posture kind of clicks into place, it kind of stays there for a while. But we happen to be in a very strange place right now on that green line, where it's kind of back and forth, and the same thing can be said down below here with the NASDAQ. So like if I zoom in on the NASDAQ, notice how this green line has basically been going straight sideways, and some days it pops up just a little bit, some days it pops down just a little bit, but largely going sideways, as opposed to seeing this, which is very consistently down, or like over here, very consistently up. So we're just in one of those weird times where there's a lot more jolting type of action taking place in the market from day to day. But it seems to me that when the market is shaking as furiously as it is right now, the direction that it's trying to shake participants into is the bearish downward direction. Now, obviously, things can change tomorrow, so you just never know. Maybe we unwind the whole thing tomorrow and we're just rocketing higher. But right now, it kind of feels more violent to me. Feels like there's more nerves in the marketplace. When we have more nerves in the marketplace, participants tend to sell first, ask questions later. So again, I think it's a time to be a little bit more conservative and cautious based upon what we're reading out of the market at the moment. So the S&P 500 down 1.85% today, does have that strongly bearish posture. As was the case when I was with you on Tuesday, continues to be trading below a falling 30-day moving average. Dow Jones was down 1.66% today. It also has a strongly bearish posture. Remember, that was the only one that was different when I was with you guys on Tuesday. That one, for whatever reason, was able to hold on to its weekly bullish posture. But here we are just 2 days later. It has joined the rest of the group. All four of these currently have strongly bearish postures, and 3 out of the 4 have price below falling moving averages. The only exception to that is the NASDAQ composite. Right now, it's trading below its 30-day moving average, but the moving average itself is still coasting a little bit higher. But remember, the more wear and tear on the chart and the more time you spend below the moving average, the more it almost ensures that that moving average will eventually roll over and follow price behind it. So it probably won't take more than another, I would venture to guess, within the next 3 trading days, unless we get a big bounce out of the markets, I would venture to guess that the NASDAQ composite will join these other 3 with the red moving average there as well. So definitely a more bearish picture that we are looking at here. What feels like kind of a little bit more all of the sudden. It's jolting to the downside to such a degree the way that it was jolting to the upside in January, when a lot of people felt like they needed to kind of get involved in the markets again, because otherwise the train was leaving the station, right? So we are dealing with a highly emotional market, it feels like to me right now. By the way, NASDAQ was down 2.05% today. And the Russell 2000 was today's worst one, down 2.81%. And remember, it was only like 2 weeks ago when the Russell 2000 was our leading index. And all of a sudden here, it's starting to really unwind in a hurry. And you'll notice that its intermediate line is now the lowest of all 4 of these charts. And that basically happened as a result of this 3 out of 4 day sell-off. Over here, that was not the case, just on the 3rd of March. So that goes to show you how quickly things can change, which is part of the reason why David and I try to do these videos on a daily basis, because if we were only doing them once a week, like a lot of the other competitors that we deal with in the financial education industry, things can change dramatically in just a few days' time. So we figure that as long as you guys are getting value out of these videos, we might as well do our best to, to put something together for you guys on a daily basis, because things can change extremely quickly depending upon circumstances. And right now we're kind of dealing with one of those types of markets. So all of a sudden the Russell 2000 has fallen out of bed in a big, big way. All right, let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these free presentations. Going back to what I had mentioned before, we try to, put these together for you guys free of charge every single trading day. Now, next week I will be gone, so just to make sure that I'm up front with you, I will be here on Tuesday, so I'll plan on doing the video with you on Tuesday no matter what. But on Thursday next week, I will be out of town. It is March Madness time, and many of you know I really enjoy that time of year, and so I've got some plans from that perspective. But I will be with you next Tuesday, and if you want me to do a full-length video like I'm doing right now for you, I ask one simple request. Simply click like for us there on Twitter. As long as we're up and over 100 likes, it gives me the impression that you guys are getting value out of these videos and that you want me to continue to do that. On the other hand, if you're not getting value out of these videos, no sweat off my back there either. It would obviously carve up a lot of free time for me during my day. And so no sweat at all. If you don't like these videos, or if you would prefer them to be much shorter, then don't click like. And if we're under 100 likes by the time I'm scheduled to do the video next, then I'll just do a 15-minute video for you there on Tuesday. So we'll let you guys decide collectively. Do you want a long form one that includes a trade application example, 12 grid analysis, selectors analysis, and all that kind of stuff? Or would you rather just stick to the basics and get in and out of the video very, very quickly? So you make your decision on your end. Either way, whatever you decide, I am totally cool with. Let's do some shout outs for those of you that were nice enough to click like for me the last time around. Thank you to Thomas. Thank you to Marty, our meteorologist up there in Upper New York. So some of you might recognize Marty. Thank you also to Michelle, and thank you to Angie. It's been nice to get to know Angie here lately. Found out she actually lives in Utah, so she's a great Twitter follow as well. There's Ken, and there's Alex, and Harry, and Randy, and Ilan, and Nietzsche, and Ken, and Irene, Floyd, David, Claire, Carl, Victoria, Prickly Trader, Teresa, Curdy, Fred, James, Nick, Serene, Judy, Leah, Barker, Rich, Norm. The list goes on and on and on. Lots of great folks out there helping support us, and I appreciate all of you. And hopefully, as time goes on, I get to rattle off your name every so often, even though I can't do everyone on every single day. It would just chew up too much time. But thank you. Please keep that up. It means a lot to both David and I. It's our easiest way to get the word out about our organization. So if you get value out of hearing from David and I regularly, that's the only request that we have out of you. Just click like. Doesn't cost you a penny and only takes 5 seconds out of your time. All right. Earlier today, as I mentioned, I did my question and answer session. David taught his portfolio management with ETFs class. I got a question about Google and how to interpret it on our different charts. I also got a question about MetaFast and some of its competitive disadvantages that it has. I got a question about how to use the special dividends gear function on Thinkorswim. I also got a question on Black Hills Corp. Some of you know I grew up in the great state of South Dakota, a very small state, one with very few publicly traded companies, but one of them happens to be the utility company out in western South Dakota, Black Hills. So it was fun talking about that one. Also got a chance to talk about IFF, which is International Flavors and Fragrances, and then also got to talk about what my typical routine is in the mornings of the various days of the week. So if you have an interest on any of that, make sure you check out the recording. If you are a premium member, remember you can find those recordings up here on the Trading Rooms tab. Also, while we're over here, let's have a talk about the factor selector. A reminder that this factor selector is now a couple of days stale. Obviously, our premium members have real-time access to it, but bring it to you a couple days late here in the free video, just to give the benefit to the premium members there. But it can still give us a pretty good idea as to what's been happening with factors here recently. And one thing that catches my eye right out of the gate is low size fell off that top position. And remember, this was 2 days ago, so it did not include today's bloodbath in the Russell 2000. But as I mentioned here just a moment ago, when we were looking at the Russell 2000, it has had an aggressive 3 out of 4 day sell-off. And that is now starting to show up in the low size factor on this factor selector tool. And I'd imagine that unless things change between now and next Tuesday, we will probably see the low size factor continue to fall. Number 2 is not that bad, falling from the number 1 position. But the way that the Russell 2000 has traded here lately, I would not be surprised to see further degradation of that rating there from number 2 possibly down to number 3 or number 4 in the next week or two. So keep your eye on that possibility. Quality was the one that was able to make it up to the top slot. Remember, despite Apple and Microsoft struggling here recently alongside the rest of the market, they have not sold off as aggressively as most other areas of the market. And so those two kind of are the lead dogs, so to speak, in the quality factor. And then on the downside, unfortunately, dividend yield has really taken a tumble here this year on a comparative basis as well. If we do start eliminating all losses in the market, all gains in the market in 2023. In other words, we saw that the Dow on Tuesday, remember when I was with you, I mentioned how the Dow had now completely eliminated all of its gains in 2023. If we see that out of the S&P 500 and the Russell 2000 and the NASDAQ composite, then we might get back to a point where dividend yield starts outperforming again. So we'll keep our eye on that. But right now, they're kind of on the outside looking in because they're considered more defensive in a year where the market was up. In addition to that, there's a lot of interest rate sensitivity to those particular stocks because there's a lot of utilities and REITs and other things in there. And with interest rates rising as much as they have here recently, that's not really helped those dividend stocks do as well as I would prefer. As many of you know, most of my own personal net worth is made up of dividend stocks. And so, it's not fun when I see this, but I always have to look on the other side of the coin, which is when dividend stocks prices are out of favor, that means new value opportunities are starting to emerge that I can start, sorting through and looking for opportunities as we move towards the future as well. All right, let's go ahead and pop back on over here to the main part of the platform, and let's do some 12 grid analysis. And we're going to start off with 5A. This is our asset class 12 grid. And you can see that we kind of lost maybe 1 or 2 green charts since I was with you last, but it is the 2 bottom corners that are of primary concern, and that is not anything new. For those of you that have been listening to me in this video over the last year plus, you should know that those 2 are my concerning areas. When those 2 in the bottom corners are in a positive bullish territory, it usually means bad things for the rest of the stock market, which is what I'm more concerned about. So when we see the 10-year U.S. Treasury yield and the U.S. dollar both with strongly bullish postures, it oftentimes means that the stock market is going to be struggling, and boy, oh boy, has it in 2 out of the last 3 days here. So today, we actually did see that the U.S. dollar slipped a little bit, but remember, Tuesday's huge move higher, we talked about that in a little bit more length on Tuesday. What we've given back in the 2 days since then is still not to even the halfway point of what we gained in the US dollar just on Tuesday alone. So we are clearly still in that uptrend there on the US dollar, still has the strongly bullish posture from an intermediate perspective, and still trading above a rising moving average. 10-year Treasury yield gave back a little bit more today, it is still below 4%, if you can believe it, even though we continue to have a massively inverted yield curve. Here's where the 3-month is today. We talked about on Tuesday how it had cracked 5% for the very first time in basically 16 years. Today it gave back just a little bit, but still managed to stay right at 5%. So it's really been the short end of the curve that the Fed controls a little bit more that has been rising without abandon, whereas on the longer end of the curve, here with the 10-year plus, we really haven't seen that follow through yet. And it could happen and it could get ugly if and when it does. So we shall see if that takes place or not. But right now we still have 100 basis points plus inverted yield curve depending upon circumstances. And remember, that's another reason why those banks are pressured. I talked to you guys about that on Tuesday. But with today, our conversation following up on financials again and being mostly around what happened to Silicon Valley Bank and all of that, that certainly took the starring role today. But that didn't somehow magically eliminate the current continued disadvantage that banks will have when we have an inverted yield curve. And so maybe the banks are starting to get spooked a little bit, or participants in the banks are getting spooked, that this yield curve is unlikely to be unwound, or this inversion of the yield curve is unlikely to be unwound anytime soon, which means there's going to be continued pressure on banks' operating models. And if that's the case, profit margins are going to be squished. And if that's the case, who knows what that means for dividend growth moving forward with those banks as well. So a lot going on there, but a lot of it is being driven by the interest rate environment, which of course in oftentimes cases is driven by Jerome Powell. So, and that is not resolving itself. And it's something that is a lingering concern. And the longer we're dealing with it, the more people are taking it seriously. So anyway, we're close to 4% on the 10-year Treasury yield, but it has not been rising as aggressively as what we've been seeing on the short end. When it comes to the two charts in the middle of the bottom rung, notice that gold was actually up today. Sometimes that can happen when we have a big chaotic risk-off type of a day in the stock market. Sometimes that money funnels itself into the gold market, which is perceived as a little bit of a safe haven asset of sorts. It doesn't always work that way, but it can, and today it seemed like it did. Now, we still have work to do on gold. I think this is a positive sign that we bounced after yesterday's oversold cluster signal, and it was up about 1% today, but you can see that we still have yet to eclipse that 30-day moving average. And until we do, I'm going to be a little bit more cautious around my mindset on gold, even though I do think that if the market continues to torpedo lower for the stock market, that gold could do better on a relative basis in that environment, right? Part of the reason that gold suffered here during, this sell-off from, late January into early February was because the market started to prefer going into stocks, and sometimes money needs to come out of gold in order to go into stocks. But we could be seeing an unwind of that situation right now. If all of a sudden people want to get out of, their more risky investments that are out there, stocks or cryptocurrency. Look at what happened to Bitcoin today. It got smoked as well, down 6%. So if that money is fleeing the more speculative areas of the market, it needs to land somewhere. And sometimes it lands, in a perceived safe haven like gold. But, again, we're getting ahead of ourselves. It's only one day. A bounce, if it eventually is to be taken seriously, needs to start somewhere, and it needs to start on some day somewhere. Maybe today is that day. But until we start seeing gold trading above its moving average, I'm still going to be a little bit more cautious around that situation. Oil had a pretty bad day. This is their third straight day down on oil. It was down over 1% today. And you can see we're kind of rounding the corner, still playing within that sideways barrier. We've been stuck kind of in a box here on oil. But it's starting to look a little bit more concerning to me, because this moving average has felt like it's been tilting lower now for basically the last, let's call it 2 or 3 weeks. And it's kind of starting to give me the impression that the momentum is a little bit more on the bearish side than the bullish side. And so, this is another area of concern, because that was one of the few areas that led the market last year and that we could get some sort of a return out of was oil and oil stocks. But right now, it doesn't look like they're willing to be our leader. And so we're going to have to look elsewhere for that opportunity. You can see, by the way, Bitcoin, of course, back to the strongly bearish posture there. So market participants starting to panic once again. And when you have, a risk-on asset like this, especially that's in the spotlight with everything that's been going on with Sam Bankman-Fried, and now what has happened to that ticker symbol SI, Silvergate Capital, it's starting to impact the psychology of participants that are trading Bitcoin as well. You'll notice here that 2 out of our 3 bond charts continue to have strongly bearish postures, but we've had a stabilization in the long-term U.S. Treasuries. We've seen that the U.S. Treasury yield has basically topped out while the shorter-term yields have continued to rise. And so the longer-term Treasury bonds themselves have also kind of just bottomed or at least coasted sideways there. So there's been a little bit more stabilization. Again, similar to my conversation about gold, sometimes you can find that long-term treasuries become a safe haven of sorts, right? Most people assume that stocks are riskier than bonds, and so some money might flow from the stock market into gold and into U.S. government bonds. And if that's the case, it could pressure those to the upside. Now, what's working on the other side of that argument is Jerome Powell continues to raise interest rates. So you kind of have competing forces there. But at least we do have stabilization here, whereas it felt really ugly with long-term U.S. Treasury bonds right here as it was going down day after day after day. This has been a little bit different here in the last couple of weeks, where it's kind of felt like it's found some solid ground. We still have work to do, still need to get above the falling moving average, similar to gold, but hey, it's a start. We've gone back to that weekly bullish posture in this case, and it was up 0.25% today. In terms of foreign stocks, we did see that they outperformed, at least the developed foreign stocks outperformed the U.S. market today. They were only down 0.73%. However, the foreign emerging markets did worse than the U.S. markets. Think of the emerging markets as oftentimes hypercharged, right? When markets are roaring to the upside, those speculative Chinese internet companies really roar to the upside at a greater degree, but the opposite is also oftentimes true. When we have a big aggressive sell-off day, then it's those more speculative areas that also get sold off even more aggressively. Notice that we do have an oversold cluster on the emerging markets. This is the first one in this 3-month period of time. Let's maximize this to look at it a little bit more closely. You can see this little dot shows up because the green, the blue, and the red lines all close below 20 on the same day on the market forecast. And that's the only green dot you see on the board in the last 3 months. Let's go back a little bit further in time to 6 months. And here you can see we had plenty of those clusters over here in that fall time period when the market was really rolling over pretty aggressively. So this is not one that is one and done. It has the possibility of having multiple clusters stacked up before it's all said and done. So got to be a little bit more careful with this one, knowing that information as well. But at least it is a start, right? We're probably closer to some sort of an intermediate low on EEM than an intermediate high, right? Over here, we had the overbought cluster signal. This one would have been an ideal one had you been, buying the bounce on EEM and then saw this overbought cluster signal show up. To sell it right here, it actually ended up marking the top, right? We never know that in real time, but we can now see in hindsight that it was the top for EEM. And had you sold it up here, you're probably feeling pretty good about life if you're now looking at it way down here where we're at with the exact opposite feature, an oversold cluster signal right here. So, there's a pretty big cohort within the markets right now that think that the foreign markets have a decent chance of outperforming the U.S. markets moving forward because they are just, quite frankly, a lot cheaper. And they've already suffered their lumps over the years of selling, whereas the U.S. markets really haven't to as great a degree. Yes, the market was down 20% from high to low last year in the S&P 500, but we have to remind ourselves that started from an extremely elevated level of very high overvaluation. So it wasn't like the 20% drop, happened from a normal valuation. So last year could have just been the warm-up for whatever the true market drop will be in the United States, whereas the emerging markets and other areas across the globe have really struggled for multiple years in comparison, and therefore they might not need to give back as much from this point forward as what we might need to here in the United States. By the way, preferred stocks also ended with an oversold cluster signal here today. Let's take a look at our sectors now. And as we look at chart 5C, as I'm sure you're probably not surprised to hear, it was the exact same thing as what we saw on Tuesday. In other words, every single one of these 11 sectors closed in the red today. Not a single sector closed in the green. And when you have only 27 stocks out of the S&P 500 closing in the green, it shouldn't be a surprise to hear that, just like it wasn't a surprise on Tuesday when only 30 stocks in the S&P 500 were up. So it was a clean sweep for the bears here today, regardless of what sector you happen to be hanging out in. But obviously there is one sector that catches my eye more than others, and that is the financials. So XLF, and remember, this one is market cap weighted, meaning that it's going to have its biggest emphasis from stocks like Berkshire Hathaway, from JP Morgan, maybe BlackRock, Wells Fargo, those bigger types of companies. Those were not the ones that got blitzed the most today, right? Silicon Valley Bank is part of XLF, but it's a very minor part of it because it has a very small market cap. So this is a pretty dramatic day for XLF, and while I didn't check, I'm going to have to guess that that's probably one of its worst days for quite some time as well. Let's go back over here out of curiosity. Over here on chart 6, where was it? 6D. And I'm just going to pull up XLF to compare to the regional bank one that we did before. This one will be just the financials in the S&P 500, but not just the banks, all the financials and market cap weighted. And you can see that this is the worst day for XLF in an entire year. Now that's really saying something. Do you remember how terrible 2022 was? I think most of you are nodding in agreement because we should all remember how bad last year was. Think about that for a second. Today was the worst day for XLF in the entire year, even though last year was dramatically worse than what we've dealt with in 2023 for the whole market's perspective. So for this one sector, if that doesn't, tell the story of today, I don't know what would. That is a dramatic move on XLF. It got absolutely smoked here today. Worst day in a year for the financials, whether you're looking at the regional banks themselves being down, 8%, or whether you're looking at a more diversified approach like this, down 4%. I'm curious if we would have to go back 3 years on this one as well to see anything as bad as this. So let's pull it up and see what we can find. So in this case, it does look like that is the case. The last time we had a day this bad would have been back in 2020, also June of 2020, June 26th in this case, in addition to June 11th, were worse than what we suffered today. So we'd have to go back to June of 2020 to see a worse day for both the regional banks specifically and for the financials more diversified and at large. That is really, really saying something. We're talking about years worth of information here that we kind of just surpassed in one single day. So very, very dramatic there. All right, let's go ahead and now get into our trade application example. And as I mentioned to you before, you should not be surprised when you come into the video on Tuesday or Thursday night, and if the stock market is down more than 1%, there's a high likelihood that I will be showing you a sold put trade opportunity, because those are the days when I like to sell puts. I enjoy selling puts on days when the market is panicky. And the reason for that is, first of all, I get more bang for my buck because volatility is a bigger component within the pricing model, and I get juicier credits for that. But oftentimes I also get to go down further on the strike chain and provide myself a greater margin of safety when I'm selling puts on days like this than the opposite. People who would sell puts on days when the market is up 2% in a day are really at quite a disadvantage from my perspective. Now, again, I come at this from a different angle because I always train you guys to only sell puts on stocks that you actually want to own for the long term, whereas other people who are selling puts don't really think in those terms. So there's definitely something to be said for that. But what I selected today was actually quite a similar situation as the Whirlpool one that I showed you guys on Tuesday. Today I'm looking at T. Rowe Price. And T. Rowe Price, unlike Whirlpool, is an actual dividend aristocrat company, right? So it's got 25 years in a row plus of increases and is part of the S&P 500. Whirlpool cannot make that claim, even though Whirlpool does have a higher yield. So, some of you might like that aspect of it. But T. Rowe Price has a lot of interesting attributes, including being the only dividend aristocrat. Remember, there's 60 of them approximately right now, 60 plus. There's like 65 or 66. T. Rowe Price is the only one of those that is completely debt-free from a long-term debt perspective. They have a little bit of short-term debt, but they have zero long-term debt. That's incredible. Now, this is a line of business that struggles when the stock market is struggling. So I want to make sure we're all clear on this as well. It's not like this is some sort of a risk-free trade. These are the types of business models that should struggle when the stock market is struggling because their assets under management are going lower when the stock market goes lower. But what I'm thinking is they've already taken their lumps to a large degree. This was a stock that was $224 just a year and a half ago. It has now already lost more than 50% of its value. And as you can see, it's now in the blue zone of the dividend stairstep chart, meaning that its current yield is attractive compared to its historical yield standards. The other thing that I was going to mention real quick is that if I were to change this to a 20-year monthly chart, similar to what I was showing you guys on Tuesday with Whirlpool, you have an oversold cluster signal here on the monthly candle charts. And remember, that is a lot more rare than the oversold clusters on a weekly candle chart, which are more rare than the oversold clusters on a daily candle chart, and so on and so forth. So the monthly aggregation period rarely produces oversold cluster signals on high quality stocks. This is one of them, in my opinion. Notice that the only other time you had an oversold monthly cluster, you guessed it, February 2009. And if that date sounds familiar, it's because it should. That was the end of the 08-09 crisis. Remember, in March of that year, we took off. So had you done something bullish on T. Rowe Price the last time you had a monthly oversold cluster signal, you were feeling pretty good about life within just a few months. I'm not so certain that it's going to work out that way this time because I still think we've got room to work our way to the downside in the overall stock market. But I do think that we are at least in an area on T. Rowe Price, a very high quality, debt-free company that's raised its dividends every single year since it's done its IPO. I think that we are in at least a reasonable territory for that. So what I did was I sold the April $95 put. And I was able to receive, I think it was like $1.15, something like that for it, $1.15, $1.20, somewhere in that general vicinity. So in other words, more than 1% return on risk. And remember what I am now on the hook for. If this stock falls from 111 here currently down to below 95 in the middle of April on that expiration day, then I would have to assume ownership of it if I had not rolled the trade prior to then. And at that price of 95, obviously the dividend yield would be even more attractive than it already is, right? The dividend yield is already above 4%. It's at 4.38% right now. And if I got my calculator out here and I took the $95 strike price and subtracted out the $1.15 in credit that I received today, my break even on that trade is $93.85. Notice that that is a little bit lower than where this stock, actually it was pretty much right at the lows of where this stock was trading at its worst possible time in October. So if you felt like you missed T. Rowe Price back then at $93.85, this might be the way to try to rectify that situation. And at that time, I'm fairly certain that its yield was well above 5%. Now, they have raised their dividend here recently just by 2 pennies, so it was a vast reduction of growth. They still raised the dividend, so it wasn't a reduced dividend. It was just that the growth was smaller than their prior year's worth of growth for this company, which again makes sense. It's a prudent company, and they are in a more difficult economic period for their line of business, managing other people's money, where assets under management have gone down so much, and therefore their fees have gone down so much over the last year. So anyway, $93.85 is our break even. So we take 122 times 4 to annualize that, and then we're going to divide that by 93.85, our expected cost basis, and our dividend yield at that point would basically be 5.2%. And that's nearly unheard of for T. Rowe Price throughout its entire history. So, it's kind of an interesting setup. Obviously, the risk is there, as I mentioned before, because this is the type of business that should struggle when the stock market struggles. On the other hand, you have to question if a lot of its damage has already been baked into the cake, and knowing that the company is debt-free gives it an ace up the sleeve, being a rare company where you really should trust that the dividend is safe, at least for the coming year, especially since they just raised it here recently. Whereas there's a lot of other more heavily indebted companies where there's real question marks as to the safety of the dividend. So anyway, just thought I would share that one with you. Another one of these dividend companies that's been sold off, that you have oversold cluster signals on monthly candle charts. So that's what I had for you here tonight. I hope you enjoyed the presentation, and if you did, I ask one simple request. Click like for me there on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do the video again on Tuesday, I'll do another full-length video. On the other hand, if you want to keep it nice and short for me next week, feel free not to click like, and we can do one quick 15-minute video for you there on Tuesday, and then next Thursday I will be off once again. So anyway, I hope you guys enjoy your weekend. Buckle up for tomorrow's jobs number. David will be with you to kind of give you the follow-up to that over the weekend. And I'll see all of you next week. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.